This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at semiconductors as use surges for AI and the auto industry.
Plus, our Treasury set up for a 2024 double-digit rally.
But first, ESG has moved into the C-suite as a backbone of corporate strategy, even if you totally don't buy into it yet. And that's according to BI's ESG Market Navigator survey, where 85% of companies plan to boost their ESG investment. Joining us now, Bloomberg Intelligence Director of Research and Chief ESG Strategist, Adeline Diab. Adeline, first define what ESG is. I know we know what it is, but define what it is and how boardrooms are looking at it. Because now I feel like if you say the words ESG, everyone runs the other direction.
Fair enough. So ESG stands obviously for environmental, social, and governance. And in my opinion, ESG is really about data, additional data about companies that really reinforce fundamental data. So it's an extension of an investment analyst role or investment portfolio role to better know what the company liabilities, risks are, exposures are, to make a more informed investment decisions. So what ESG is about better informed investment decisions. What it is not, it's woke, a reduced investment universe, or doing good necessarily. It's really about companies that we have information about how well their operations are, their management is, and that is to make better informed investment decision.
Well, I think for better or worse here, at least in the U.S., Adeline, ESG, A, they need a different label now because that one's not working. But B, it's become politicized. And I know that is generally not the case in the rest of the world. But is there differences in your survey between U.S.-based companies and non-U.S. based?
Question.
So that's an excellent question. And the reason we did our survey was really actually to cut through the noise and to really understand what were the investors and companies' perceptions, real perceptions on ESG and priorities. And actually, so our survey represents EMEA, US, and APAC, but globally, despite the fact that ESG is polarized, at the end of the day, including US investors believe that ESG helps better returns, improves fundamental analysis, and helps craft better or more resilient portfolios. So that's our findings. 85% of investors believe that ESG leads to better returns, resilient portfolios, and enhanced fundamental analysis.
So, yes, and I feel like shareholders, though, particularly in the U.S., if you say the word ESG, there's a big backlash against it. When are we going to get to the point where a boardroom can show investors, here is the actual data. This is how you make money if you boost your ESG standards versus here's how you lose money if you don't. Where do you think we are in that data process, like you were just saying?
So data remains a challenge, but I guess it's more of a challenge in terms of data integration within systems. But at the end of the day, global regulation is what is driving ESG, so regardless of what's happening politically. And the second driver is competitiveness. So ESG helps companies understand where their industries or how the industry landscape is changing and how they need to adapt, and then identifying the right metrics to share with investors. But what we're seeing as well is accountability is the big focus for 2024, and we're seeing an increase in investors taking companies or holding companies to account, where we see 60% of investors asking questions about ESG to corporates, and 40% of executives recognize that they face ESG questions on half of their calls.
Interesting. All right, Adeline, thanks a lot. Adeline Diab, who's Bloomberg Intelligence Director of Research and Chief ESG Strategist.
All right, sticking with ESG, let's turn now to municipal governments and their plans to weaken climate risk. For more, we're joined by Bloomberg Intelligence senior ESG climate analyst Andrew John Stevenson. Andrew, thanks so much for joining us here. So give us a sense. We're always talking about ESG and things like that in the context of corporate America. What are local municipalities trying to do?
Sure. So up until very recently, municipalities have basically had a free ride. So the government, we would have a giant disaster of one kind or another, natural disaster. The government would basically come to the rescue and spend quite a bit of money, about $560 billion over the last 20 years.
Wow. To
help rebuild and, replace a lot of existing infrastructure in the municipalities. And so this was the local municipalities had to put up about about $26 billion in total over that period. So it's about a 20-to-1 payback. Obviously fantastic from their point of view, but the government, which has been using stimulus packages to pay for this, is becoming less and less interested in stimulus packages, and therefore the municipalities themselves may have to foot the bill, and this is just a ginormous amount of money for the municipalities to have to cover on their own.
I love the word ginormous because that's exactly what I was kind of thinking about. Is there, I mean, obviously if you're an investor, like you get a nice little tax credit for this. Like, is there going to be the demand for the supply that we're going to have to see from this?
Well, it's not quite clear yet how much of this is going to disappear, but the stimulus package is paid for about 70% of these recovery. And these are all grants, by the way, which are obviously very high value dollars if you're a municipality, grants going to infrastructure, right? So the only alternative for something like this is these are not self-financing. This is usually when municipalities, they build a road or with a toll bridge or, with a toll or something, there's a way for them to recover the costs of the investment other than just better economic, activity in their area. And in this case, these are really non-self-funding bonds. So you're talking about general obligation debt, and this would swamp the general obligation market. This would be the equivalent of 75% of all outstanding general obligation debt. So it's a bit of a head scratcher how it's going to be recovered, in one way or the other. Either they're going to have to issue debt, which again would have to be not kind of non-revenue generating, or they would just have to kind of make do with less.
So, I mean, I think about, our good friends down in Florida. It seems like every few years, unfortunately, they get hit by a big hurricane. Historically, the government's funded the recovery, correct? And now you're
FEMA,
saying that
right?
What's that?
FEMA.
Yeah.
And so FEMA and HUD, they've both been very good at, paying for these things. So in Florida's case, it's about $50 billion of money they've received, and they've put up about 10, maybe it's 8. So you're looking at, very, very good. It's a very good value for the localities up until now because they've been getting these, highly leveraged dollars, high multiplier dollars.
Yeah, and it kind of raises the question here. All right, didn't we replace or rebuild this mansion down in Palm Springs once or twice before in my lifetime? I'm going to rebuild it again. Is that kind of thought?
Well, no, these aren't the homes. So this is
just kind of the property down there.
But no, this is just infrastructure related to recovery. So this has nothing to do with personal. If you build it, you bought it. You know what I'm saying?
Yep.
So you if you don't have insurance, the government has also come to help you in some ways, but the cap on those are $250,000 and not big dollars, right? So if you have a multi-million-dollar mansion, you're 90% on your own anyway.
So
sorry.
No, I was going to say, I feel like I want to make a distinction though, because one is going to be, here's funds you need to do to replenish and help yourselves rebuild after a climate crisis versus like, here's money we're going to have to raise in order to do climate funding stuff. And they're different, right?
Sure. There's mitigation, right? Which is looking after the future. And then there's just, let's pick up the pieces, right? And it's about 2/3 of it is pick up the pieces, and about 1/3 of it is what's called mitigation, which means the government says, here's a big pot of money. If you have any good ideas, we're all ears, and we'll help fund it, right? So those are the dollars and they have a really high multiplier. In the FEMA's analysis, every $1 invested in mitigation delivers $11 in economic net benefit to those communities. So you want them. You want to do that stuff.
How about in Texas? Because, they have a lot of issues, but certainly the climate seems to be the big issue there for them.
Yeah, they obviously have had a lot of issues related to ESG. This is nothing to do with this is just dollars. Like this is where they're going to come up with this kind of capital. And if you look at what's happened to them, and it's a very clean example. Over the last 6 years, they've gotten $69 billion from the federal government in the form of grants to help recover from some pretty awful storms, right? And if they had to do that on their own, they would have to have done it through the general obligation market. That would nearly triple their outstanding issuance in that space, which is, kind of very, very difficult to do, if not impossible. It has very little to do with ESG. It has a lot to do with this was money that we've been using historically to get by when we've had big storms. It's starting to disappear on us. How do we replace it?
Andrew John Stevenson, thank you very much. Bloomberg Intelligence Senior ESG Climate Analyst. Coming up on the program, we're going to see if automakers can eke out a $15 billion revenue gain next year.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
So automakers may add $15 billion in revenue next year, but with 2019's price volume tandem in the rear view mirror, good times may be over. We're pleased to welcome Bloomberg Intelligence Senior Autos Analyst Kevin Tynan. All right, just set up the premise for us. $15 billion in revenue next year. They're adding that. I don't know. That doesn't sound like a lot. Is that a lot?
No, it's not, and that's sort of the point. Is that you're talking $15 billion on $740 billion, and the increase from 22 to 23 is about $100 billion. So what we're basically saying is that we're kind of at the end of the runway, and the idea that you can continue to grow volume while increasing transaction price is basically over, and that the normal relationship between the dynamics of supply, demand, inventory levels, price, and volume is going to go back to what we've known basically forever in every business and in every segment, is to say that you can increase volume a little bit in 2024, but you're going to pay for it with lower pricing, or vice versa. You can be firm on pricing, but don't expect volume to go up much from here. So,
but aren't we making more money per car now? Isn't the industry, more profitable?
Yeah, it is, and again, we feel like it's kind of the end of the runway, where you're talking about $48,000 average transaction prices, which is a heavy lift for a lot of consumers. Automakers have knocked off the bottom parts of the portfolio that are low revenue contribution, low profit margin vehicles, and basically saying, look, if you don't want to buy up here at these lofty levels, we don't really have the product for you. So there's going to be a trade-off that says, we want to protect margins, or we need more volume, and we're willing to let pricing go. But something has to give here, where we went through a period of both at the same time, which would be growing volume off a low base during the pandemic, but also that tight supply and demand balance driving prices higher at the same time.
So what is reflected in the valuations of these stocks? Like, what side are they coming down on?
Yeah, look, I think we had a window, and I say we as the people that care about the auto industry, that, there was this idea that electrification and would change the paradigm, that these were tech companies now, whether it's advanced driver assist systems or electrification or software, that there was going to be a realignment of multiples that say these are more like tech companies. And I think that window is closed. And what we're falling back to is the traditional, you're a metal bender looking for scale globally or regionally, and you're going to go back to what you've always been. And that's kind of the point here, is that a lot of what we believed in terms of profitability of EVs and demand for EVs is starting to fall away and show that it really isn't the case going forward, at least in 2024.
So, but if I listen to an earnings call, or if I listen to a management team from Ford or GM or Stellantis, am I going to hear that rhetoric?
No, definitely not. Definitely not. I mean, but if you read between the lines, look, Ford is delaying investment in battery plants. GM pushed out its EV target, and I think the idea was that, these are simple vehicles to make fewer moving parts. You can make them in a tent with robots, and everybody's margins would go through the roof. And that myth is sort of falling away now. And the next profit driver, which was expected to be EVs, really isn't living up to the hype. And now the industry is kind of looking for the next thing that says, okay, we need to make more money, and we can't just keep shifting the mix to more truck from cars. We're kind of tapped out there.
So I've been really fascinated with pretty much any industry that's caught in a structural shift, like for the car guys going to EVs, but still are in a cyclical industry. And I feel like that complexity is very difficult to price. And that's exactly what the traditional automakers are in the middle of. Like, they absolutely have to make EVs. They eventually have to make a profit, but they also have to make a profit right now. How do you think this winds up playing out?
Yeah, I mean, and if you look at it, and again, I think some of the issue is that using Tesla profitability or business model as a benchmark was a bad idea, and that goes to everything from direct sales. You have Rivian and Lucid that have to deliver everything that they produce. Otherwise, your cost of goods is really high and your revenue is really low. And I think there was a lot of that we're starting to see now doesn't make sense for legacy automakers. Even if you look at Tesla, just pure profitability took, 10 years plus? What automaker that already has profitable technology is willing to weather that? Ford Model E is $4.5 billion in losses this year. How many years? Do you want to do 10 years of that? And I think you're right, Alex. That's exactly the problem.
All right. So what do these guys do? I mean, they have to go electric and hybrid and maybe in the interim, don't they? So I'm looking at these. I don't know what these guys do, and I can't imagine investing in GM or Ford, because if they do go electric or continue to go electric, it's going to cost me a lot of money as a shareholder.
Yeah, I mean, and look, that assumes that it has to be 100% electric. There's a world that says we're not 100% minivan or 100%, four-cylinder engine versus 8. So perhaps this winds up being a niche technology, and maybe it's 25% of the market at the high end or less, because it works for certain groups in certain areas, but it isn't the singularity that was expected because it just doesn't work, or it's not profitable, or whatever the myriad of reasons winds up being. But there's that scenario out there that says, yeah, we have to do some hybrid, plug-in hybrid electrification, but it doesn't have to be the only option we have in our portfolio.
Exactly. They were sort of dialing back that huge rush. Which car company do you think is set up best to sort of navigate this weird thing? Well, I'm so professional. That thing that we're doing with EVs.
And it really depends, right? If you say, look, this is going to be unprofitable for a really long time, you would argue that the companies like Toyota or Stellantis, who are considered to be very far behind, at least in the United States, well, they're the best position, right? Because they're not doing something knowingly unprofitable. On the other end, you could look at somebody like Ford and say, look, they got 3 products, battery electric vehicles in Mustang Mach-E, Ford 150 Lightning, and then E-Transit, in the commercial business, that says, this could cover everything that we need. And if people want to buy it, we have a good chance of selling these things profitably and, not see further expansion of the EV portfolio, but they have some coverage already.
So do you have a model, Kevin, that has Ford, GM, Stellantis being able to produce an EV profitably on a unit basis? Well,
not at the price that people would want to buy it. And you look, and if you look at things like Chevrolet Bolt or even Nissan Leaf, right? People talk about Nissan Leaf. Is it profitable or is it not? And I simply point to, well, they sell about 12,000 a year. So my guess would be it's probably not profitable. Otherwise, this $34,000 EV would be selling all over the place if you believe, what the demand model is supposed to be.
Interesting stuff. Really cool.
Kevin Tynan was right about this whole thing, by the way.
Yeah, and also, and basically, this is Paul being like, so was I.
Yeah, exactly.
Kevin, thanks a lot. Kevin Tynan, a Bloomberg Intelligence senior autos analyst.
Coming up on the program, we'll take a look at what's ahead for Treasuries in 2024.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Treasuries are poised for double-digit returns in 2024 with a recession and tepid recovery predicted by Bloomberg Economics. To help unpack this, we're joined by Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey. Double-digit returns in 2024. Boy, after 2022 and 23, that would be welcomed by, Treasury investors. How's that going to come about?
Yeah, it really just has to do, Paul, with the tepid growth and with lower inflation. Our expectation is that the Fed will start to cut rates either at the end of 2024 or early 2025. And as the market prices for that, you're going to see much lower long-term interest rates. So you could see a significant reduction in 10-year yields, like down about 100 basis points from where we currently are.
What?
Nice.
That feels crazy.
Well, someone sitting with a mortgage with a 6% mortgage.
Oh, you have 6%. That's
Yeah.
actually not as bad as I thought it was going to be.
I know. But you're like...
Yeah, I'm
yeah,
sub 3. I'm
yeah.
sub 3. Ira, what kind of economy are we in if you see 100 basis points lower on the 10-year?
Yeah, not necessarily a recession, but in a slow economy that is not enough for inflation to reaccelerate. So that's that's the premise of how yields in general get down much lower. But one of the interesting aspects, I think, of what might happen in the market next year is that you'll still see an inverted, maybe less inverted, but continue to see an inverted yield curve throughout almost all of next year, and that's predicated on the idea that we have, and this has been for all year basically. Our thought is that the Federal Reserve is going to be very reluctant to cut interest rates because of the past inflationary environment, and once it does cut interest rates, it'll cut very quickly. So ultimately, you can wind up with a very flat yield curve. We talked about this before, Alix, a pancaked yield curve, where basically the market's pricing for interest rates to be lower, but only on a forward basis. That will take some time to kind of develop, I think, into 2024. But ultimately, because of the changes in the Treasury market, so with more 30-year and 10-year debt outstanding than there used to be, a rally of 100 basis points from here means that you're going to get, the 4.5% that you're getting more or less from the long end of the Treasury market, plus capital appreciation of between 3 and 7%. So you're talking about a double-digit types returns for a lot of different bonds within the Treasury market, if we're right.
So have we? I guess by definition, have we seen peak rates then, Ira?
I think we have. Could we retest 5% at some point in the next couple of weeks, before year end, if we wind up getting a higher inflation print, and if the Fed is surprisingly hawkish at the December meeting, maybe, yeah, we could retest that level. But I think if we haven't seen it, then it's not going to be much higher than the 5% level that we saw on 10-year yields. And more than likely, we probably are past the peak. I think the big question for investors who are thinking about buying Treasuries, going into year end and for 2024 is, do you think that inflation is going to continue to slowly get lower and that growth won't reaccelerate? And if you believe in those two things, then right now is probably the best time of the cycle to be thinking about, engaging into the Treasury market and into fixed income in general, quite frankly.
What kind of volatility will go along with all of this? Because it feels to me like it's not only how much they cut when they cut, but the window between the peak and cut, like that changing super fast, or how compressed that'll be is also kind of the question.
Yeah, the market's been, the market, remember, 6 months ago was pricing for cuts by this time of the year,
right.
and we haven't seen those.
Right,
So,
I forgot about that.
so the market is changing its opinion on a minute by minute, data print by data print basis, listening to the Fed, trying to figure out what the Fed's reaction function is going to be while it's pricing for what the Fed's going to do next. Now, I think that the Fed is done hiking, but the question is, are they going to cut as the market thinks maybe by the middle of 2024, or are they going to cut later? Are they going to maybe not cut till 2025? I think that's the next question, and that's where you'll see a lot of volatility. And I agree, we're going to have a lot of volatility. In fact, just this past week on Thursday, the Federal Reserve of New York hosted the Treasury market conference, and a couple of the panels were about market volatility and what's causing market volatility and the funding markets. And just about every single market participant who are on those panels agree that volatility is here to stay. We're going to continue to see very large moves relative to history in Treasury yields, and a big part of that is uncertainty. But I think even a bigger part is the fact that we have a lot of debt outstanding and a lot of people are moving in and out very quickly. You don't have strong hands right now in the Treasury market.
Do you have the hedge funds short the Treasury market? Because I know that was a trade earlier. I didn't know if they've unwound that.
Yes, so that is at least partially unwound. You've seen you have to be careful with which data you look at, because if you look at the futures positioning data, that does suggest that hedge funds are short, but there's other things going on under the hood there. So there's things like people shorting Treasury futures versus buying cash Treasuries, right? So that's what we call the infamous basis trade, so you have to be careful with what data. But a lot of people were short. A lot of people were in what we would call bull steepening positions, where they were long the front end of the curve and short the back end of the curve. Those trades actually worked out okay in the recent backup, and they're starting to work a little bit more now with the 2-year starting to catch up with the rest of the market in terms of rallying, with yields moving somewhat lower. We were at 5.30 not so long ago on the 2-year yield, and now we're well below 5%, right? So you've seen a pretty big pullback there as well. So I do think that the fast money community is kind of trading this as opposed to having any significant long-term positions.
Yeah, I mean, I remember when the pancake curve was going to be pancaked, but at 5%, right? That definitely feels.
Well, we got there very briefly.
It did for like a second. What about something unrelated to the Fed, and that's just straight up supply and demand? I keep waiting for that, and I appreciate we might have seen that push yields to 5, but is that going to come up again in the same way that we were worried about it 3 weeks ago?
So I think supply is going to continue to be a worry and fear by just about everyone, because we are going to have meaningfully large deficits over the next few years. Our forecast for the current fiscal year that we're in now, that ends September of 2024, is for $1.7 trillion deficit, which is basically on par with what happened last year. But then our projections are for the deficit to increase in subsequent years by a couple of $100 billion. So supply will continue to worry people. The thing with supply is it changes, I think, the magnitude of moves, and particularly moves lower in yield. But if you get a very weak data, if you wind up with disinflation and you wind up with the Federal Reserve cutting, the Treasury market will rally. It just might not rally as much as it would have if there was much less debt, right? So I think that's the difference between the high level of debt that we have now versus where we were, say, in 2015-16, when we had much less debt than we do today.
All right, Ira, thanks so much. As always, we always appreciate getting your thoughts there. Bloomberg Intelligence Chief U.S. Interest Rate Strategist, Ira Jersey.
Let's turn now to semiconductors, where we are seeing a shift in demand, and that's thanks to a surge from AI and the auto industry. So for more, I want to welcome Bloomberg Intelligence Senior Semiconductor Analyst Kunjan Sobhani. Kunjan, this is a really dumb question, but how are AI chips used in cars?
Well, so it's a combination of both. The two fastest growing end markets over the next decade, as we forecast, are supposed to be automotive electronics, and AI primarily is going to drive the data processing end market.
So, I mean, I just bought a new car, and I honestly feel like I bought a computer with 4 wheels. I mean, it's just ridiculous how much technology.
Did you have an
is
AI
in
in your car? Like, do you know?
I don't know.
You know.
It's beeping all the time.
It's some kind of smart chip that
I'm
does
leaving
stuff.
lanes. I don't know what's going on, but it looks cool. It looks cool. All right, so talk to us about the auto industry. Where are we in terms of putting chips into cars? Because that really came to light during the pandemic when, we had some supply chain issues. So where is tech and the auto industry right now?
Yeah, I mean, it is sort of in the first innings. I mean, we have been putting chips into the car over the past decade, but the rate at which we are putting chips in the car is really accelerating, and especially it will almost 3 to 5x jump when you go from an internal combustion engine to an EV. So that's what sort of a combination of putting more chips, putting more safety features, infotainment features. Like you said, your car is like a computer on wheels, more comfort features. Everything is driven electronically, so you need chips. And now suddenly if you go to a pure electric vehicle, you need like 5x more number of chips now because your entire engine, your powertrain is running on battery.
Are these the same kind of chips like a data center would run, or are they inherently different?
No, they're inherently different.
Okay, so do we have enough of them for the cars?
At the point we do. I mean, traditionally, automotive used the mature node manufacturing, which, we have plenty of. And the contention always has been on leading edge nodes because those are not the capacity for that is smaller and it's very expensive to produce. Now we are seeing this new trend of using leading edge nodes chips also in automotive, but automotive still as a percentage of all the other end markets is still a small percentage versus data center is huge. So we have enough chips right now to suffice to that demand.
Where are we, this may be a little off topic, but just kind of the onshoring or friendshoring of chips these days. That was kind of all the talk several years ago. I'm not really sure how much has actually gotten done or will get done.
There's plenty getting done. First of all, to set up a brand new leading edge node fabrication plant takes at least 3 to 5 years and tens of billions of dollars of investment. So not something, the bill just got passed last year, right? So not something we can see right now. But our forecast suggests, as of today, Taiwan controls 42% of the world's leading node capacity. By 2032, we forecast that the U.S. and Europe combined will control about 45%.
Oh, wow.
So that's a significant change in the landscape. Of course, barring that, these plans go according with different governments and nothing gets roadblocked.
So what is the end market here in terms of we got the autos and you have consumer electronics. What are the other end markets for these kind of AI chips, and how is that going to evolve in the next 10 years?
Well, the primary market for AI chips is the data centers. That's where you have all these ChatGPT and generative AIs, right? And these are the biggest buyers because they have the deepest pockets. Sort of the next wave that we predict would be AI going into your edge devices. What I mean is like your PCs, your smartphones. In fact, even your cars, when you have autonomous cars running, they're going to have a lot of AI. So that's sort of the next wave where we will see AI penetrating in those edge devices.
So I know that the chip business, the semiconductor business, is a really cyclical business. And if you want to invest in this space, you got to be right on predicting the cycle. Where are we in the cycle these days?
The cycles are different for each end market. So over the past sort of 12 months, we have gone through a PC downturn and a smartphone downturn. And PCs have started slowly recovering this past quarter. We are seeing some good signs there that PCs are coming back. Smartphone, there is some green shoots, but not a very strong path to recovery yet. We hope 2024 will be that year where smartphones will start coming back. Cloud, because it's been so new, especially the generative AI, we have not seen that major cycle, the decade cycle. We see small sort of seasonality pockets that these end cloud providers buy a lot immediately and then say, okay, we got to digest. And in terms of automotive and industrial, we have now, over the past quarter earnings, started seeing some weakness over there, some sort of a digestion. So the consensus is that for the next couple of quarters, at least first half 24, these two markets are going to show some signs of sort of a smaller cycle going down with recovery expected in 25.
Interesting. So smaller cycles, but still cyclical. What are the companies that we're talking about? When you think AI, you always think NVIDIA. But as it relates to, say, the auto sector, who else makes the chips?
The legacy auto chip makers were your NXP, right? Your ADI, your Texas Instrument. But like we said, there's this new use cases that are going in automotive and is becoming a computer. So the traditional sort of processor guys are the new and upcoming ones like Mobileye, Qualcomm, NVIDIA. So these are sort of the new, players on the block, which are looking to grab a big piece of this pie.
How have these stocks been trading this year?
Apart from Qualcomm, I think the NVIDIA, is the best trading stock in the S&P 500. But all the other AI names, like I said, Intel, AMD, Broadcom, all the AI names have seen a pretty healthy rally.
Which is why I think it's so interesting, though, because clearly there's a structural shift in that a lot of things are going to be powered by these kind of chips, but you're still in a cyclical business. And I feel like that kind of caught a lot of people offside because 2 years ago in the middle of the pandemic, it was all like, no, guys, it's the Internet of Things. We're going to use all these chips forever. This cycle's never going to go away. And that has definitely changed. And I find that to be quite interesting and I would think very difficult for an investor to kind of wrap your mind around.
Exactly. And I mean, people who have been in this industry, I've been in this industry for 20 years, but people who have been in longer, there's always this debate between the old guys versus the new that, the old historical data will say semiconductor is always going to be a cyclical sector. Mm-hmm. But the new data suggests, well, no, it's becoming a secular sector because these AI sort of secular trends and automotive, they are not going to die down. I think it's somewhere in the middle. I think semis is definitely becoming a long-term secular space. But given the long lead times, the time it takes for you to put an order and get a chip made and the time it goes to the end consumer, I think there will be definitely these mini cycles going on from time to time from every 2 to 3 years.
All right, thanks so much, Kunjan Sobhani. We appreciate it. Bloomberg Intelligence Senior Semi Analyst Kunjan Sobhani.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.